Hey everyone, Paul, and welcome back to the channel, or welcome to the channel if you haven't been here before. And in this video, I want to walk through Hertz. So when we talk about Hertz, and this has been a wildly popular speculative stock that a lot of investors have been kind of, chasing, thinking that, hey, this is at a really low price, maybe that makes a good opportunity for me to be buying it. And this stock is, in the last, few months been as low as, about 50 cents all the way up to over $5. So it's really kind of been on a pretty wild roller coaster, but it got even more wild last week. So when we look at this stock last week, so when we look at it, it's currently November 5th when I'm filming this, but we say that October 29th, when this stock was delisted from the New York Stock Exchange, it ended that day at about $1.78. And again, it was delisted. It resurfaced on Monday on the pink sheets and the over-the-counter. And what that was is that basically the New York Stock Exchange said that this stock no longer lived up to their standards to be listed on that major exchange. And so they were moving them to an exchange, where the risk can be a little bit more apparent that it's not a quality company that you might be getting involved with. Okay, so getting delisted was certainly a big, development with this stock. So that being said, for me though, one of the more, kind of alarming things with Hertz is if we actually rewind the clock a little bit. So they went bankrupt May 22nd of 2020. And after bankruptcy, so in June, so just a couple weeks later, they basically rolled out a plan because if you're bankrupt, you need money. Okay, you can't pay your debts. So they said, hey, we're going to put together a plan as a company. And Hertz said, we're going to sell $500 million worth of our stock, partially able to do that because it's propped up from, retail investors bidding the thing higher, chasing it, hoping that they can actually get some short-term gains out of this thing. But they said, okay, if our stock price is kind of actually, holding up decently well, given the fact that we're bankrupt, let's sell additional stock to the tune of $500 million to the public so we can get some additional funds. But here's what, again, is really shocking about that development is that when Hertz made that decision, they were also, pretty openly saying that we think our stock with this bankruptcy process is in all likelihood going to be worthless. Because when you go through bankruptcy, the debt holders, the bond holders, anything else, they're first in line to get paid. So they're already in a spot where, the debt holders of Hertz are very likely not going to get a full payout. That's the most likely scenario. So if they're not going to get fully paid, the equity investors will have nothing left, and whatever you're putting in would essentially be worthless. And again, this is pretty much the company admitting that was going to be the case, and then still turning around and saying, but hey, why not? Let's raise another $500 million. Now the SEC, a regulatory body, for stocks and investments, they stepped in and they were not as thrilled about that. And they said, wait a minute, you want to sell $500 million while you're going through bankruptcy, and you're basically telling, shareholders that are listening, you're basically telling them that this is going to be worth $0, and you're turning around and trying to sell this, right? They weren't happy about that. They shut them down. But even to the point that they actually shut them down, they still were they still were able to sell $29 million worth. Now, when you look at that in the grand scheme of things, in terms of most stocks and whatever else, $29 million is not, a huge amount, but still, just to be thinking that they sold $29 million of new stock, again, knowing that in all likelihood that was actually going to be worth $0, 0 cents. Okay, and the speculation continues, by the way, because when we actually look, so when that stock Hertz was delisted and it was taken off the New York Stock Exchange, it's going over to the pink sheets. When that happened, their stock price opened up, it was about 70 cents when that all happened. Okay, and then we look at it today, it's up to 90 cents, and just today, November 5th. We're looking at this stock being up over 5%, but just from when it's actually been delisted, just in this week, it's actually up over 20%. So again, we still see that speculation continuing for a stock that once again, in all likelihood, is going to be worth $0. And I know a lot of this is that people, I think, are maybe jumping in and they're hoping, well, it might go to zero. They might say, hey, I know it might go to zero and it's 90 cents today, but if I can get in at 90 cents and take it to $1. If I can just, get that quick profit, sell it, I'm good to go. That's all I need, So they're like, hey, I don't care if it goes to zero in the long run. I'm just in it, to get some kind of quick profits. And, you do you if that's your style. Like for me, I'm really trying to emphasize a long-term investment approach. I'm trying to, say, hey, invest in quality companies that you believe in, that you have a reason to believe that they're going to do well. And it's also backed up, by some understanding of the valuation of the company, whether it be, from an attractive price to earnings ratio or price to sales, or ideally, if they're actually generating some free cash flow, that you're able to kind of, give some estimate about what that free cash flow per share is going to be, project some of those things out, and then again, if you're going to discount that back. These are all different methods you could use to value a stock that I think, if you're going to be investing for the long run, make a lot more sense. So again, if your whole purpose is to just trade and whatever else, again, do what you need to do with that. Of course, consider your own, risk, level and things of that nature. But if you're a long-term investor, I don't really think there's a strong case you can make for wanting to own this stock. It just doesn't seem to me that the risk reward makes sense. But, let's also take a look at this, because you might be saying to yourself, well, because even at the start of the year before the pandemic hit, this stock was trading, up over $20 a share. And you might have been saying to yourself, well, okay, you couldn't forecast the pandemic, but what red flags existed about this company that would have made you less inclined to actually invest in Hertz? And I want to walk through that, because I think this is actually pretty important too. And because when you think about Hertz, by the way, this is a company that has been around for, I think it's about a century. They can trace back their history. So this is not a case of a new company that's in a growth phase, where they, having negative free cash flow or, losing money makes sense. So again, that can make sense. You're a software company, you've been around for a couple of years, you're growing your sales like crazy, you're losing money. That can still be speculative, but you can kind of look past that a little bit. But again, in Hertz's case, they've had a century to figure out how to be profitable. And, at least in the past few years, they've shown that they've really kind of fallen off the rails in being able to generate any kind of profit. So let's go ahead and take a look at, specifically what I mean by that. Okay, so if we look at some of the financial data for Hertz, so again, if you were thinking about investing in this before, let's say you're sitting around January 2020 and thinking to yourself, hey, is Hertz a good long-term investment? Is this a stock that I should buy for the next 5, 10 years, whatever that might be? Well, let's take a look at it. In 2019, they had free cash flow per share of negative 13.26. In 2018, it was a negative 19.79. And in 2017, it was negative 8.7. They finally actually generated $2.40 per share positive free cash flow in 2016, but in 2015 it was actually a loss of 70 cents. And once again, if you're not already familiar with it, free cash flow is really kind of saying, take a look at your operating cash flow that the business is able to generate and kind of subtract out any cash flow needed to sustain the business, like capital expenditures, things of that nature. And it's a good measure of what cash is available to shareholders. Now, they have different things to do with that available cash to shareholders. They could reinvest the cash in the business, they could issue dividends, things like that, or at least additional. But that's just an understanding of how much free cash flow is available to the investor. And when you know that number, you can kind of start to, again, get a good sense of how you can value a good, profitable, company that's been around, for as long as what Hertz has been around. So when you say the fact that, of the last 5 years, that 4 of the last 5, just from 2015 and 2019, they've actually been burning cash, not generating cash, there's your first red flag about this company. The second one, and this is actually, probably should be the first one, this is actually what did them in, was, their debt load. When you look at this, their total debt, and, what their total debt was, you look back in 2016, they had $13.5 billion in total debt. That increased to $14.8 billion in total debt in 2017. 2018, it was over $16 billion. And then 2019, it was $19 billion in debt. Do you see a trend there? The fact that they went from the $13.5 billion to $19 billion in just a short number of years there. And then, oh, by the way, if you look at what the revenue was, I mean, that was relatively flat as well. So you look at the fact that, okay, while their debt was increasing at that level, if you look in 2016, they had revenue of $8.8 billion. 2019, it was about $9.8 billion. So it's not like that debt was justifying, some kind of sales ramp up or anything like that. In fact, the debt was really, a combination of a few different things. So, I mean, this company has went through several different CEOs. I think they've went through 4 different CEOs in the past decade. That's never a good sign when you're seeing that kind of turnover at the leadership position. Again, in fact, another red flag for Hertz. But when you also look at some of the strategic missteps of Hertz, they were, I think for a little while there, they were really trying to be cheap as far as updating their fleet of cars, until they got to the point where customers were very openly complaining and defecting to other providers in that market because just they weren't getting the quality for their value, and they didn't want to be part of that. And then the other one was the company for a little while there was trying to rely on offering a different type of car that the customer wanted. So they were relying more on the affordable sedan model as opposed to SUVs that customers were starting to crave and desire more from Hertz. But again, they were more expensive, so they kind of were late to wanting to provide those. So those were a couple of the issues. And then, of course, this has been a negative, or it's been a headwind for all of the car rental companies when you look at, the growth of Lyft and Uber. So you think about, before with Hertz, which primarily services the business side of the car rentals. Before, if you're at an airport, whatever else, it's like you might have the ability to rent a car or get a taxi. And now, it's just much easier kind of when you're at the airport, it's easier to, Uber around or get a Lyft and things of that nature. So it's just yet another option that you would have if you're traveling for business. So that's hurt them, but really at the end of the day, again, when you're carrying that much debt, for as unforeseen as the pandemic is, but having that weak of a balance sheet, especially when you're burning through as much cash as what they were, those should have already been enough red flags to help you avoid an investment in a company like this. Now, we can also kind of talk about this, and that's what part of this channel is for, is that there are a lot of companies out there that are really good, strong companies that are generating a significant amount of free cash flow per share. There's companies out there that are not only negative, but they continue to increase their free cash flow per share on a year-over-year basis. So there certainly are examples of companies that have strong balance sheets, examples of companies that are generating lots of cash at a positive growing rate. And again, I would really encourage you to be looking at those companies and kind of, getting into that level of detail to understand, just how your company is doing financially. Because again, nobody can predict the unexpected, but what you can do is you can say, if something crazy happened, you can say, could this company handle that or couldn't they? Clearly in Hertz's case, they couldn't. So that's my take on Hertz. And again, guys, I think that, it's not just going to be Hertz. I think that there's always going to be that temptation that when you're watching a company, on the verge of going bankrupt, and you think to yourself, boy, if this company could just turn things around, maybe they could really be worth something. Like you would have said this through JCPenney. As they were kind of declining and heading towards bankruptcy, you could have said, hey, they used to trade over $40 a share, and if I'm getting it for $1.50, what if they could return to that heyday? What if they turn things around? Turning $1.50 into $40 a share, that'd be a home run. That'd be great. Again, my take on it, I'd love to know, is this something that you're currently trading? Do you have any kind of long-term hope for Hertz? Were you investing in this before? What brought you to the channel? Let me know what you guys think about this video in the comments below, and see you next video.